Good evening. My name is Rajdeep Nayak, and you are watching Rutherford Value Investing channel. So, first of all, today we will discuss about the various facets and philosophies of Benjamin Graham that he have discussed throughout his life. So, in this endeavor, let us first understand what is an investment. So, an investment is a phenomena that is undertaken by an investor to purchase a stake in a business, and that would guarantee him adequate return throughout his tenure of investment. So, as Warren Buffett always advocates the principle of value investing in his various works throughout his life and Berkshire Hathaway annual general meeting and his communication with the shareholders, that the philosophies laid down by Benjamin Graham with regard to investing are of paramount importance in this respect. So, first we need to understand what are the Benjamin Graham's philosophy with regard to definition of investing in particular. Now, when we talk about investing, so Benjamin Graham has put up this particular philosophy in a very beautiful definition. So let us read out the definition. An investment operation is one which, upon thorough analysis, provides safety of principal and an adequate return on that principal. And any other operation which does not meet these two criteria are not considered as investing principle, but they are rather speculative in nature. So there are two important facets to this definition. Number one is the safety of principal. Now, what is the safety of principal? Suppose we are investing amount of X into any particular security or any particular investment asset class that doesn't have any uh, underlying capability to produce any particular goods or services and so on, and does not have any tangible means to justify its valuation in the market, cannot provide us with the safety of its principal, because we don't know upon which underlying the value has been provided in the market. And then comes the return of capital. So return of capital, as we all know, whether we deal with market ended securities or exchange traded securities, or with regard to bonds that are money market instruments, or with regard to our fixed deposit, every investment carries a interest on the principal amount. Now the interest can range from 5% to 10%, 20%, and so on. So there are, when we talk about return on investment, there are two important aspects we need to understand. One is return of the capital, and the other one is the return of the principal amount. So both goes hand in hand. That when we talk about return on principal, then we talk about that 5, 10, or 15% which we get compounded annually over our invested principal. But then we also need to consider the return of capital, which ensures that our basic principle will not be eroded away. Because as we remember, the Warren Buffett's first principle of investing is that never lose money, and the second rule is don't forget rule number one. So that is also imperative to maintain our principle intact over a period of time over which we are investing. So again, investment operation is one which, upon thorough analysis, provides safety of principal and an adequate return. Now, if we talk about various investments in various asset classes, we will see that this definition is very strict, because any kind of operation which does not meet this principal safety and an adequate return over a period of time will be speculative, as per Benjamin Graham, of course. Now, while doing this, an investor must keep in consideration that there are always some risks which are associated with the opportunities of making this gain over a period of time. This risk can be the risk of inflation, the risk of going concern, the risk of successful competitor being coming away, the risk of funding, and there are many other regulatory risks that can be posed against the business in which the investor is investing. So there are some inseparable risks from opportunities of profit that they offer, both which taken into consideration for investors calculations. Now, there can be intelligent investor, or I would say intelligent investment, and also there is intelligent speculation. As per Benjamin Graham, any speculation which is not unintelligent is a intelligent speculation. So our first job is to understand what is a unintelligent speculation. So now Benjamin Graham has a three-way approach of describing the characteristics of unintelligent speculation. So number one, where he says that when you speculate, thinking that you are investing. So in today's world, if you talk to the market participants, they would say they are engaged into doing derivative, engaged into derivatives and FNO, where in fact they think that they are actually investing. But as we know from the definition that given by Benjamin Graham, that anything which does not provide safety of capital and ensures adequate return to that capital is not investing, it's a speculative activity. So that is number one characteristic where it is regarded as a unintelligent investing, or I would say unintelligent speculation, when you are speculating but you think that you are investing. The second approach he takes is that speculating seriously instead of having a pastime, and you are putting in more money than you can actually lose. So in terms of margin trading or in terms of derivative, whether it's currency derivative or you deal with commodity derivative or any kind of FNO, where people get carried away and put in their effort and money to that extent which exceeds their sustainable capability, about their risk appetite. So the second characteristic is tells us that when we deploy more capital and instead of having a little pastime where we want to negotiate with our behavior which leads us to speculating, that defines the second characteristics of being an unintelligent investor. So we should always keep in mind, if we are extremely craving for this particular speculating activity, we can do that, but with regard to small amount of capital put in aside, so that we can deal with that kind of biasness in our mind. So coming to the third characteristic, which says that risking more money in speculation than you can afford to lose. So that is actually subsumed with the second characteristic only. So these are the three characteristics which Benjamin Graham came out, that anything or any market participant which is who is following these kind of three characteristics is considered to be indulged into unintelligent speculation. Now, when we talk about unintelligent speculation from the population group, if you remove these particular characteristic, we land up with the remaining portion, that is the complementary portion for the broad class of broad class of speculation. So that is known as intelligent speculation. So the next issue that Benjamin Graham addresses with regard to margin trading facilities. Now this is one of the hot topic in today's investing world. Many discount broker and full-time broker also come up with this particular concept called margin trading facility, where you don't have the enough capital to purchase the lot in derivative or FNO segment, and you have been provided with a certain cushion of capital by your broker, so that you engage into a much larger transaction than you can actually satisfy with your given amount of capital. So that is a margin trading facility, and where they charge particular fees or brokerage in terms of providing that service. So it's the broker's duty that to differentiate between the investing and speculating activity. And in today's world, if you see, if any broker is into AMC or providing portfolio management services or providing mutual fund services, they should be worth their salt and explain to the potential investor or potential speculator that in which activity they are indulging into, and make them aware that what are the type of results or probability of the results they can expect. But instead, if you see various reports being coming up with the regulator that in speculation and F&O trading, only 1% is the success rate, because with regard to artificial intelligence, algo trading, and so on, people who can have the institutional mechanism or characteristics with regard to infrastructure can only gain through it, because they can understand the anomalies of the human behavior, and that put into real practice can very easily defy the other end of the equation, which consists of individual speculators. So it's the broker's duty to make speculators aware that they are indulged into such and such kind of speculative activity, which can lead to erosion of their capital. But at the end of the day, we see that none of the brokers to that extent is involved into making that clarification to that particular speculator. Instead, they would entice them, and that leads to devoting their time, I mean the speculators' time, into voracious speculative activity, dealing with F&O, dealing with derivatives, and putting uh, in their hands where they have a very little experience or knowledge and how to do that. So that is the second challenge which Benjamin Graham talks in detail. Next, these leads to the euphoria of IPO investing. Now, IPO investing is a kind of euphoric activity which is seen by the market participants. If we analyze them thoroughly, then we would analyze that all the IPO activities, I would not say 100%, but most of the IPO activities comes in a bull market when there is a euphorism going on. And market participants, whether it consists of various DIIs or retail market participants in particular, they are ready to pay any price if certain kind of things are attached to the name of the company or operation that has been provided in the red herring prospectus. So that is also an euphorism. And if you think that by providing or subscribing to an issue of an IPO allotment, we are actually investing, then we are very wrong. Actually, we are dealing with the gambling activity or a speculative activity, being a punter in those particular activity that we involved ourselves. So this thing is all about IPO investing, and we would later discuss about IPO investing in great detail, where Benjamin Graham has come out with a philosophy specifically for IPO, but that we would discuss much later. So now we have distinguished between what is a investing and what is a speculation, and what is the group called defensive investor, and how that is distinguished between the defensive investor and the enterprising investor. So now let us say a defensive investor also have some expectations of results, that we have carried out certain activities and what kind of results we can expect. So the results to be expected by a defensive investor. This has been discussed in great detail by Benjamin Graham. So let us understand some of the nitty-gritty of the result that can be expected by a defensive investor. So he says that a defensive investor can very well use the service of a recognized investment counsel, which will give him professional administration of his investment program along standard lines. Now, here we need to understand this in the light of present scenario that we are moving through. Uh, that is, we have market regulator SEBI. Under market regulator, there are various DIIs, and these DIIs mostly consist of the AMC houses, and they have certain kind of services being provided to the subscribers to their schemes and NFOs. So these can be categorized between broadly the portfolio management services and the mutual fund scheme services. So when he talks about the defensive investor result, he uses this particular phenomena where the defensive investor can put in his hard-earned money to a scheme known as the SIP, systematic investment plan. When we talk about systematic investment plan, as we all know, that the basic characteristic of systematic investment plan is that we are putting x amount of money every month or in a particular period, repeated every time within that time frame, where irrespective of the fact that whether the market is going down or the market is going up. So in that process what happens is when the market is going down and we are putting x amount of money, that leads us to buying more and more units at that particular NAV, or if we are doing SIP in a particular stock or a group of companies, then we can accumulate more amount of unit than our previous purchases, provided the stock prices are going down and down and down, and we are providing the same amount of capital. Similarly, on the other hand, when the market is moving up and we are providing that same amount of X, then we are gathering or accumulating lesser and lesser amount at the higher prices. So in a holistic view, when you compute your total picture on an annual basis, you will see that you have contributed to the buying and accumulating your units, or I would say stocks, both at higher prices and at low prices. But the main concept behind SIP is that you are buying less amount of unit at higher prices and more amount of unit at the low prices. So uh, that leads to averaging down your cost of investment. So this is one very akin to that particular concept called formula investing in global sense, and in Indian context you can say that is rupee cost averaging, which in US it is known as dollar cost averaging. So by this methodology, you can have a good amount of return, because if you think that a particular stock is trading well below the intrinsic value as compared to what it is being quoted in the secondary market, and you are gathering or accumulating that unit over a period of time in the form of SIP that we have described just now, then you can expect a fairly good amount of result going forward. So when we talk about the next category, that is the aggressive investor or the enterprising investor, there also we can sum up that what kind of result the aggressive investor can expect. So first of all, a brief description about the aggressive investor. He tries various sorts of mathematics and candlestick charting analysis, then Elliott waves and whatnot. There are many tools, and in today's world, these tools sometimes comes with payment subscription, or it comes on a free software basis on various websites. But the problem is that when we deal with the market, we have to understand who is the fool, whether we are the fool, or with regard to that who is the other end sitting on the counterparty seat. When we deal with the counterparty, there can be an individual market participant, and also there can be a DII or an institution which we are dealing with. Now, at the inception, the inherent discussion about aggressive investor is that we can assume them to be speculator rather than becoming an investor. So when we deal with aggressive investor, where he tries various mathematical aspect and various tools and figures into play for achieving a great deal of entry into the market and a favorable exit at times. So he can learn about all those tools and techniques, but putting those techniques and energy and rejuvenativeness into the play can leads to some pitfalls at times. So here Benjamin Graham says a very beautiful connotations, that it is no difficult trick to bring a great deal of energy, study and native ability into the Wall Street, and to end up with losses instead of profit. These virtues, if channelized in a wrong directions, become indistinguishable from handicaps. So, as we see, handicaps have a very little activity to that extent as compared to a normal human being. So, when a speculator starts or an aggressive investor starts his journey, he has these all guns blazing, because he thinks that he has X amount of money and he can invest Y amount out of that X, and at times with a great deal of exit. in under favorable terms as he wants, he can make a lot of earnings within a short span of time. So that can prove to be very fatal at times when we indulge into shortcut as a aggressive investor. Now, there are certain techniques which are followed by the aggressive investor, which Benjamin Graham has categorized under three types of activities. First one is trading in the market. Trading in market means buying stocks when we think that the euphorism will continue in a particular sector or in a particular stock. Now, when we deal with euphorism, then we need to understand that whether we are following the fancy, because when we follow the fancy in the market, we end up paying a fancy price, and for that soon the fancy ends and we make a fancy loss. So there is no other outcome that we can expect when we deal with fancy in the market. So trading in the market leads us to a conclusion that we purchase at higher price in our anticipation that it will go even further, with regard to the greater fool theory, that there will be some other set of fools who will indulge into buying it at some later point in time. But that is with regard to lack of clear perception and lack of clear research at our end, which we believe that there will be a greater fool theory which is effective, but in substance that time never comes or it seldom comes. So when we deal with fancy, we must recognize that we are about to make a fancy loss, because we are buying at a higher price and we are selling at a low price subsequently. Then this technique of trading in the market also entails one another important aspect of short selling. Now, what is short selling? Like in normal way of dealing with securities or buying stocks, first of all, we doesn't have the stock. We make our thorough analysis and research work at our end, and when we conclude that the particular stock is trading below its intrinsic value, then we deploy our funds. And after purchasing the stocks and holding it for a long period of time, we see that the stock has traded over its intrinsic value, where we feel that we should dispose of the stock at a good profit. So this is normal way of taking a position and then subsequently squaring it off over a period of time. But in short selling, the reverse thing happens, that we doesn't possess any stock, neither we have funds, but we entail into some particular mechanism where we can borrow that particular stock from those people who has those stock at that point in time, and then immediately we sell those stock in the first place in the open market. And our anticipation that those particular stock price will decline over a period of time, because we have some theory in our mind, and that theory is not backed by any proper reasoning, or to that extent it's very convoluted, I would say. So we think that the market price will decline subsequently, and when it will decline, we will square off our position by purchasing it at a even lower prices, and the difference will be our profit. But the problem with short selling is that when we borrow something from somebody, he can ask any price for that, because only those people which have or which possess the stocks can ask any price for the stock in the first place. And when we purchase the stock from, or I would say borrow the stock from the people who have that stock in the first place, they can ask for any price, and we don't have the limit of our losses. Because suppose we borrow a stock at 100 rupees, then we anticipate that that particular stock will decline to suppose 80 rupees or 60 rupees or 50 rupees. But in spite of declining, uh, or I would say instead of declining, that stock advances. And when it start advancing, then the lack of confidence sets in. So that particular advancement can be unlimited. It can go from 100 to 120 to 130 to 150 or even 200. So our losses is unlimited in terms of short selling. So that can prove to be really fatal when it comes to short selling. So both these aspects of trading in the market is nullified to be a operation which can be considered as a investment activity. Second technique is short term activity, or I would say short term selectivity, and the third one is long term selectivity, which is followed by an aggressive investor. Now, the problem with short-term selectivity is that at the outset, he believes that the company which has already reported or is expected to report a good result, he indulge into buying that particular stock outright without having a thorough research about its 10 years or 15 years or 20 years track record, and how management has discussed in management discussion and analysis in their annual report and in their conference call transcript. So these can also prove to be outright mechanism for losing their initial capital. Then, when we talk about long-term selectivity, the thing, the term long-term may encompass that certain things are put in place which are right in phenomena, but actually they are not right, because when we deal with selectivity in long term with regard to aggressive investor, he has a very short time, or I would say akin to mental accounting heuristic, where he does not process all the information that has been given to him, and he ignores a lot of information with regard to any particular company or a particular sector to that extent. So in terms of long term selectivity, what he does is he anticipates that okay, this company is providing a good result, and the media reports or news that has been provided or fed to him from various sources, that this particular company will be providing this kind of similar growth in profitability or in revenue from operation in times to come. But there is again a problem with this approach, is that he may go right in selecting the stock but at the wrong time. Now, how does that can happen? This can happen in two ways. There are two problems associated with this short term selectivity and the long term selectivity per se. First of all, when you expect that particular company has already provided a good result, or it's expected to provide a good result in the next quarter or in the next coming year annually per se, then you may go wrong in your anticipation. And even if you are right in your anticipation, the current CMP, that is the current market price, has fully discounted that factor into valuing that particular stock in which it is being traded. So there is a very little to negligible mismatch between the price and its intrinsic value that it deserves. So both these concepts, that is short term selectivity and long term selectivity, has their own drawbacks. The first drawback is about going right with the anticipation, and the second drawback is that even if you are right, then those particular factors have been discounted appropriately in the current CMP. So your chances of generating an alpha over a period of time is very very less. And initially, when you pay the price which is a little higher than the intrinsic value, then your chances of making profit is also lower. Now, the second problem is with regard to the fact that you follow a herd mentality. When news are flowing thick and fast to various sources, and which is being fed to you or bombarded upon you, then you ignore many other negative things that can happen with that particular stock. So you will find yourself to be following that herd mentality, and what others are doing, you are also doing the same thing. So all these three activities that is being carried out by an aggressive investor to that extent is trading in the market, short term selectivity and long term selectivity, can prove to be inefficient strategy when it comes to value investing. Then Benjamin Graham comes up with a solution that is to be followed by both the aggressive investor or a defensive investor if they want some particular clarity in their expectation of a good result. So this solution entails them to believe that going forward they should have a proper expectation about their result, not an euphoric expectation that the market will reward them. So this solution comes in a two-step process. Number one is inherently sound and promising results by the company. So by this, Benjamin Graham means that we should do our proper research work at our end when we select a particular company or a particular sector, to that extent, out of so many sectors that are listed in the secondary market. So if we follow that annual report per se, for last 10 years, 15 years, and 20 years to that extent, and following all the footnotes to the financial statement. And when I say financial statement, it includes both the three integral part, that is balance sheet, statement of profit and loss, and cash flow statement. So if you see the revenue growth for the last 10, 15, 20 years, and the revenue growth and the profit after tax growth, and there are various accounting ratio which is showing favorable result as it is expected from a good company, then you can say that it is an inherently good company with a good management, with a sound management principles, and a good corporate governance also. So you can get a 360-degree taste about how the company is going to unfold in the next coming decades. So in this way you are providing a safeguard to your selection process, and also an expectation that how the revenue can unfold. The next step is about not being popular on the Wall Street. So this is very important, that when we are selecting a particular stock on the basis of some particular theory or research work, the other thing that need to be kept under consideration is that the other herd, that is the other market participants, are not doing the same thing. And this is little harder to go by, because being a rational contrarian is not an easy task at the outset. Because when you select a particular strategy and you discuss that outcome with the other market participants, they may defy you or they may agree to you. So in that set of defined uh, in that perspective, when we talk about that decisiveness, about whether we cling on to our own research work when all the other market participants are not agreeing with our conclusion what we have done at our end, then it should not perturb us from taking a particular financial investment decisions in a particular company. So the two-step process is: number one, it should be an inherently good company showing inherently and promising good result and proper business principles going forward, with a proper good governance, good management. And the second one is that you should be following your investment plan with regard to those companies which are already not popular on the Wall Street. Like many market participant doesn't even know that particular business, or even they know the business, they doesn't make themselves aware of that particular company. So you are an early bird of the retail category which is taking a stake in that particular company. So this is a two-way process. Now Benjamin Graham came up with a caution when following this particular solution, that it may be not an impossible task to do, but at the same time it is a very tiring task, and sometimes it takes a long period of time, a substantial period of time, to get hold onto those particular opportunities. And in the meantime there may be also some cases where you lose some opportunities, that Warren Buffett says the error of omission, not an error of commission. Because when you see certain kind of sectors or particular companies which have already been euphoric or having a great deal of valuation, having a valuation which is far more exceeding than their intrinsic value, then you do not take the position. But you see subsequently those companies are advancing. As far as the CMP is concerned, they are advancing far more than your expectation, where they should decline if you go by the real philosophies of investing. But you can't expect to be appropriately accurate with your expectation that how long an euphorism can go on or last in the market. So it's better to stick to a particular philosophy, that we are investing in a particularly inherently good company, and that has a promising track record, and that will unfold proper business principles going forward, that give rise to good amount of profitability. And secondly, it's all about choosing a very unpopular company within the set of, let us say, thousands and lakhs of companies that are being listed. So Warren Buffett has described this caution in a very beautiful manner, where he says that although the principle is sound, its successful implementation, even if it is not impossible, but it is distinctly not an easy art to master. That I just described right now. You can need to have a substantial period of time putting in do your research work, doing all sorts of analysis, self introspection, theory of inversion as described by Charlie Munger before you take up on your final call. Now, this particular solution comes with two kind of techniques per se when you identify that whether this particular company is distinctly and inherently good company or not. So this brings us to that particular juncture where we need to value the intrinsic value of a company. When you talk about intrinsic value of a company, the mostly followed method is discounted cash flow, and the other less popular method is working capital approach. Now, let us first discuss about the discounted cash flow approach. When we talk about the discounted cash flow approach, we discount the future cash flow of a particular company with a modest rate of return, which is generally the treasury bill, or I would say the fixed deposit rate of return. And by taking those return, we add a risk premium to that particular return because we are taking a risk on the secondary market, and with that particular effective interest rate we discount all the future cash inflows to this present moment. So after we have discounted all the future cash inflows with the modest rate of return, that is the effective interest rate, then we get the intrinsic value of the whole business in particular. Now, this is the intrinsic value of the whole business. Now, our objective is to find out the intrinsic value per share. So that is very easy. If you go to the balance sheet of a company in the annual report, there we can have a disclosure about how many outstanding number of equity shares we are having at that point in time when we are doing the calculation as per the latest balance sheet. So if you divide the total intrinsic value that we have just computed with the outstanding number of equity shares, then we can get the par value, intrinsic value of that particular business. Suppose we have 10 lakh as our discounted cash flow, and we divide it by the outstanding number of shares, let us say it's 1 lakh, then we get the par value, which is the intrinsic value per share of that particular business that it deserves. Now the next step in discounting discounted cash flow method is that we have to compare the intrinsic par value of the share that we have just computed with the current market price in which it is listed in the secondary market. Now, on the basis of comparison, we can find only two possibilities. One, where the current market price is already more than the intrinsic value, and the second possibility is that the current market price is less than the intrinsic value. So in the first case, when we find that the current market price is more than the intrinsic value, then we can say that the company is being overvalued. Now, whether we will take the particular stake in the company when it is already overvalued or not, that depends upon individual decision. If it is just slightly over the intrinsic value, let us say 5% or 10%, then we can think about with a lot of self introspection and secondary research that whether we should be holding on to that opportunity or let it go. And second possibility that can come to us is where the market price is below the intrinsic value. Now, when the current market price is below the intrinsic value, then we can say that we are getting it cheap. So the more gap is there between the intrinsic value and the current market price, where the current market price is trading well below the intrinsic value, the more cheaper we are getting. So this difference between the intrinsic value and the current market price is the margin of safety that is described by Benjamin Graham a lot of in his theory that we will discuss some other day. But today, the margin of safety means when the current market price is trading well below the intrinsic value per se, and that gap is known as the margin of safety. The more the margin of safety, our initial capital will be much more secured, and we can have a adequate sort of assurance that we can have a good amount of profit in terms of return on investment going forward. So this is known as discounted cash flow. The second method is a less popular when we come to practice, which is working capital method. Now, by the term working capital, we all know that working capital is the difference between current asset and current liability. In current asset, if you imagine the balance sheet, that in our current assets there are some common categories of asset that comes, which is trade receivables, inventory, cash and cash equivalent, and some other bills receivable, and so on and so forth. And in terms of current liability, we have these trade payables, then bills payable, and some short-term, very short-term loans, and so on and so forth. So the difference between current asset and current liability, where we have a particular position of net current positive assets, we say that this is the working capital. Now, when we follow the working capital method, one particular philosophy that is advocated by Benjamin Graham, that we shouldn't take into consideration the addition of the property, plant, and equipment or non-current investment, that is the any other asset which is not been taken into current asset. We should not take those asset into consideration. Suppose we have non-current asset, then we have current assets. Only the difference between current asset and current liability, which is our working capital, should be taken into consideration, and that should be compared with all the other liabilities that is in the balance sheet. So by this methodology, what we do is, in practical sense, is that we are getting all the non-current assets and the non-current investments of the company, which is being demonstrated in their balance sheet for free. So our safety, to that extent, when we talk about the margin of safety for an investment, is secure to a great extent. But the problem with this approach is that when you look at the balance sheet of most of the companies, even very well defined and enterprising companies, and which have a long track record of providing good result, we cannot find these kind of companies very often. It's very, very rare, and it's negligible to find. So that's why this approach is considered to be very less popular in mm, I would say in practice. But nevertheless, if you carry these two approaches simultaneously when you are doing your research work at your end before selecting a company, then no one knows that you can get a hold of these kind of rare opportunities at your stance. Now, if you can't get opportunity with regard to working capital approach, then you have discounted cash flow, where you can take the stand that whether you should be able to take a particular stake in a company or not. Video, we have already discussed in great detail about some tenets of investing as laid down by Benjamin Graham, and I think that should be it for this video. And I will see you all in my next video, where I will bring to you some enlightenment from Benjamin Graham, where he discusses about some other philosophies. Actually, this is an ongoing process and a never ending process, and I endeavor to deliver my best of the learning that I have learned till this point in time in my life, to share all those knowledge with you and get your feedback in times to come. So thank you very much, and have a good day. Thank you.